as well as the speakers over here to give more. Only because of such high participation, the enthusiasm among the Thane branch committee members has been very high, and we are looking forward to organize more such events. We would also request you that if you have any suggestions on any of these events, please do come forward and please do let us know what we could organize for you. And if you have any suggestions, please do let us know where we could improve and serve you better. Nonetheless, our chairman, sir, will deal into the upcoming events of the Thane branch of ICAI. Today's event is one of the issues that we all majorly deal with, that is important issues under direct tax. We have with us CAPU's Charged, and I would like to thank him for removing his time from his busy schedule for enlightening us with his knowledge. Before proceeding ahead, I would request the CA Shiv Bhagwan Asawa, the chairman of Thane branch, to give his opening remarks.
Thank you, C.S. Swapnil. Dear members, a very warm welcome to all of you. It is nice to see consistent large number of attendees in all our seminar. This encourages us to do more for our fraternity. Coming to today's seminar, important issues under direct tax, and to deal with the subject, we have CAPUG Charged, a very down-to-earth person. We also recognize presence of RCM nominee Sri Kamlesh Sabuji. And before going further, we have few announcements. Vocal for Local Speaker Series 4, we will have 2 more seminars. Requesting everybody to be in mute mode. Vocal for Local Speaker Series 4 will have 2 more seminars. Tomorrow we have Sanjay Khimani, who will be dealing Resolution Framework 2.0 for COVID-19 related stress. And he is Thanekar and the only gold medalist, that is All India first rank in CA final from our city. And on Sunday, we have young and dynamic Thanekar Omkar Gadgil, who will be dealing with intricacies of ITC in GST. Please do attend in all the days. Respected members, I encourage you to freely ask any question to Piyush sir, but in through chat box only. One more thing, let's make this session engaging and helpful. Now, I request CA Ankush Gupta to introduce today's speaker, C. Piyush Charged. Over to you, Ankush Gupta.
Yeah, thank you, sir. Today's speaker, Piyush Charged, is my childhood friend, and I feel proud today that we are in the same professional platform. CA Piyush Charged is son of late Shri SP Charged Sahab, past president of ICAI.
Sorry to interrupt, Ankush भाई, आप दो से आप ज्वाइन हुए हो, जैसे इको हो रहा आवाज, एक को बंद करिए प्लीज. Please. Sorry. Thank you, dear. Thank you.
I request everyone else to kindly keep their phones on mute mode so that there is no disturbance during the event. Please keep your phones on mute mode. Thank you.
Yeah. Hello. Now is it okay?
Yes. Carry on, Ankush bhai.
Thank you, sir. I'll start all over again. Today's speaker, CA Piyush Charged, is my childhood friend, and I feel proud today we are in the same professional platform. CA Piyush Charged is son of late Shri SP Charged Sahab, past president of ICAI in 1999. Piyush is a senior partner in Charged & Doshi. His expertise is in direct and indirect tax, appellate proceedings, and arbitration proceedings. He is speaker on various topics of direct tax in almost all the professional platforms. Apart from being a regular co-opted member in various committees of ICAI and WIRC, he is also a member of External Advisory Committee of RBI. He is contributor to various publications of WIRC, latest being WIRC publication on Vivad Se Vishwas scheme, and most recent being WIRC publication on Finance Act 2021. He is also an independent director in various listed companies and also trustees in various trusts. With this short introduction, I welcome our speaker for today's topic, important issues under direct tax, CA Piyush Charged.
Over to you, Piyush ji.
Chairman of Thane Branch, Shiv Bhagwan ji Asawa, Vice Chairman Swapnil, and other committee members of Thane Branch, my friend, my brother, Kamlesh Shabu, the regional council member, the active regional council member. It's my privilege to be part of Thane branch today as a speaker. And the way this program of Vocal for Local, which I'm seeing since I think so, this is 4th series, and the way this program has garnered success, it's really a hats up to the whole team, including chairman and vice chairman, and the whole team and the members specifically, because without the members' participation, no program can be successful. And I'm seeing the participation of members on in each day, every series, every program that keeps on increasing, and it's really very highly recommendable. So with this, the topic given to me is on issues on direct taxes, important issues on direct taxes. So my concentration would be on very important aspects, more which are connected with amendments made in last year and the current finance act. And then also I will also try to touch quickly to the perennial issues which keep on continuing. As we know, income tax has always been an important matter for our practicing chartered accountants. Though there are a lot of fields which have opened up, like indirect taxations, company law, NCLT, but invariably, direct tax remains the core business activity for our professionals. And even after a lot of smoothening, lot of changes happening, still, if you see the last 2 years, completely direct tax has been revamped. Not only by way of the Finance Act 20, but also there were 2 ordinances. Then there was Finance Act 2021. And most importantly, even after such amendments, there is a lot of issues still continue. That's the most important, because after one particular amendment is made to cover up something, but really speaking, it throws up much more issues. So I'll try to highlight those issues. I'll try to, so my pattern of basically discussion would be, what is the provision of the law first? And what are the key points and issues which needs to be looked into it, which could be addressed? To whatever extent I can address or I can give my views on those issues, I can give. But there may be some unresolved issues which still remain, and only time will tell when the courts take the view on those issues. So with this background, I'll start my presentation on important issues in direct tax. Chairman sir, my screen is visible?
Yes, yes.
Okay. So important issues under direct tax. Thanks. So first of all, as I said, my concentration would be on the recent amendments, and we'll try to look into what these amendments are all about and what are the issues still which will continue even after the amendments, why these amendments were been done, and how we can overcome. Now, question is whether we can overcome or it will remain unresolved. But it is important to understand those amendments. And the first and foremost is the amendment which was made, which I would like to touch upon, is goodwill, which has been discussed day in, day out in newspapers, at various professional forums. There is an amendment in existing goodwill provisions. Existing provisions, there was a Supreme Court judgment in case of Smith Securities, which said that goodwill is covered under the definition of intangible assets, and whatever goodwill you are recording in your books of accounts would be eligible for the purpose of claiming the depreciation. Now, depreciation on intangible assets was 25%, which was quite substantial. Now, let us go into the history of it. How does the goodwill was actually been created? Generally, goodwill is created when there are takeover arrangements, there are mergers between 2 companies, or there is a slump sale. As we know, in case of amalgamations or merger, Accounting Standard 14 issued by ICAI is compulsory. So you have to do an accounting based on AS 14. What does the AS 14 says? That amount paid over and above the book value of the assets at the time of takeover, merger, or amalgamation should be recorded as goodwill. So as per the AS 14, all the associates who were taking over the new companies, who were taking over the businesses, were recording the amount paid in excess of the amount as a goodwill. If the amount was less than the book value, then we were crediting it to capital reserve. So this was been goodwill debited. So if an 100 rupees asset which I had purchased, if I take it over business of having a book value of 100 rupees, it's been taken for 200 rupees, this 100 was debited to goodwill, and I was getting a depreciation of 25%. So the mergers and acquisition was quite feasible because I was getting a benefit of 30% tax, 25% tax now, and therefore it was very good. And that Supreme Court judgment was very welcome. Now I think so. Department did not like this, and therefore they would have approached CBDT, and ultimately Finance Ministry accepted that goodwill is not covered under the intangible assets, and therefore this amendment is made in this Finance Act 2021. The amendment has been made at the 3-4 places just to cover, in fact, that the depreciation should not be allowed in the goodwill. Section 211, which defines the block of assets, has been amended to exclude goodwill. Similarly, amendment has been made in section 32(1)(2) and explanation 3 to section 32, which defines the what does intangible assets include for the purpose of block of assets, and from them goodwill has been excluded. Another provision has been added to section 50(2), just to whatever goodwill is already standing in the books of your accounts as on 31st March 20. Please note, this amendment is effective from financial year 2021, that is assessment year 21-22. Though this budget was passed on 28th March 2021, certain more than 50% of provisions have been effective from the previous, that is financial year 2021, as good as in a retrospective in nature. So what does 52 amendment has been made? That wherever depreciation has been already claimed on the goodwill, you should freeze it on 31st March 2020, opening balance, rework the depreciation which has been calculated, arrive at WDV of goodwill in the total block, because that block of intangible assets may contain various other assets like goodwill, you may have software, you may have technical know-how. So you remove the block of goodwill from there, and after that 1st April 2020, no depreciation should be gained. Now, because the depreciation has been stopped on the goodwill, what will happen when you acquire a goodwill? Goodwill will be treated as a capital asset, and for that purpose, section 55(2)(a) has been amended, whereby how the cost will be calculated in case of goodwill has been treated capital asset. So for this purpose, the following amendments has been made. Now, what are the important key points which have come in this? It is important to be noted, and what would be the issues which will be involved is important. Now, please note from 31st March 2020, depreciation will not be allowed on the goodwill, because if you see the definition of intangible assets, it said technical know-how, so and etc., and rights of any other commercial or similar nature. So it said any other commercial or similar nature. Now the courts have interpreted any other commercial or similar nature, commercial or similar, because that's not defined, will include goodwill, and therefore goodwill was eligible. By way of amendment, it says now any other commercial or similar rights excluding goodwill. That is what it is. Another key point is cost of acquisition of self-generated goodwill. There are self-generated goodwill, like we have a professional firm and there is a self-generated goodwill, and we may pass an entry of raising the goodwill in the books of accounts. Cost for the purpose of income tax will be treated as nil. Then we need to adjust the closing WDV of intangible assets. So these are 3 important key points as far as adjustments are required. Important key points. Another most important, which is an issue which I would like to put out in this amendment, which has not been taken care of. I think so, it has been misfired. What happens is, because AS 14 says that amount paid over and book value has to be recorded as a goodwill. That's why we were recording as a goodwill. But technically, when you are acquiring a company, you do not acquire only the tangible assets. There are a lot of other intangible assets. Intangible assets includes know-how, patents, copyrights, trademarks, licenses, franchises, or any other such similar rights. So it is possible for me to divide this into various heads as a matter of convenience. And because my AS 14 mentioned that this all excess amount should be debited as goodwill, I was taking it to goodwill. But technically, goodwill actually didn't represent, the amount in goodwill didn't represent it as a goodwill. There were various other elements of that, which includes customer rights. Now, the taxpayer have argued that goodwill is a part of any other business or commercial rights, and therefore Supreme Court allowed it, whereas revenue didn't want to do it. This is the background. Now, this amendment has been made from 2021, distinguishing between goodwill recognized during tax neutral transactions and non-tax neutral transactions. Now, let us think why this amendments, why this restructuring was happening. There are two types of restructuring. One is there is actual takeover which is happening, and one is within the group just to consolidate various companies, a mergers were happening or a slum sale was happening, and therefore this goodwill was recognized. Unfortunately, the amendment made in the various sections disallowing depreciation do not recognize this. It does not recognize that in case of tax neutral transactions where the amalgamation or demerger, even when the goodwill is recorded, the depreciation should have been allowed, and non-tax neutral transactions such as some sale. So it does not distinguishes. In non-tax neutral transactions, some say if the depreciation would have been disallowed, it would have been fine. But unfortunately, it does not does it. Similarly, considering the amendment, now what will happen after amendment? Now, whenever there is a merger, whenever there is a slum sale, it may happen that we will not actually allocate this amount of goodwill. I can allocate to various heads. This takes me to a certain judgment of Delhi High Court and case of Hindustan Coca-Cola Beverages and Areva T&D India Limited. So the question came over a consideration that amount which was debited under goodwill, whether a depreciation should be allowed or not. Those with security said that depreciation is allowed on goodwill, but Hindustan Coca-Cola and Areva didn't went to that. It says, though it is debited at goodwill, technically the amounts are not paid towards goodwill. It includes various other rights like marketing and trading reputations, trade style and name, territorial know-how, habits of customers, patents, secrets, marketing rights, marketing distributors, customs rights. So, various other which have been acquired at the time of acquisition. So it doesn't stop me. I can, whenever the amount is paid in excess of the book value, I can actually distribute that amount under these various rights. I can do a valuation accordingly and state that the amount paid over and above the book values represents towards marketing rights, towards the customer contracts, towards the lease contracts, towards business information, towards business records, towards employee, and I can still claim it under commercial or other similar rights because that only excludes goodwill. Goodwill was only a convenience, even in case of slum sale. So Delhi High Court is still in support, and in my view, that support Delhi High Court will also hold good. There's another judgment of High Court of Delhi also. In this case also, when amount was paid over and above for the shares which were acquired in case of a transfer and transferee company, the company paid an additional amount towards commercial rate, a separate additional amount for marketing, customer support, distribution, and other setups. And depreciation was allowed in those cases. So according to me, this amendment would actually hardly serve the purpose of the department in disallowing depreciation, because I can now break up and a small amount can go to a goodwill. The issue may arise in the case of slum sale, because in the slum sale, there is a lump sum consideration. And if I actually allocate, a question may arise that if you are allocating into a various rights and the various assets, tangible and intangible, then whether it's a lump sum consideration and whether it should be treated as a slum sale. So this issue may remain, which I would cover further when we also discuss the slum sale issue. So this takes me to a slum sale. Now, in case of the slum sale also, like mergers and demergers, whenever I used to acquire the business, then we used to enter into a business transfer arrangement, whole unit is taken for a lump sum consideration. And the amount which is paid over and above was recorded as goodwill. Though AS 14 does not apply to slum sale, please mind it, AS 14 does not apply to slum sale, it applies only in case of merger. But as a matter of convenience, I used to record it into a goodwill. Now I can break up so that my depreciation can be allowed. Though AS 14 does not allow, so in merger, demerger, I may not break up, I will still record as goodwill. But in income tax block, I can say commercial or other similar rights, not excluding the goodwill. I can still continue with that. Now there is a small amendment in the 50B also. But the amendment is a very small of section 50B, which deals with the slum sale. But you will believe the impact of the same would be quite high. So this both put together, goodwill and the amendment in the slum sales, would be really affecting the way the transactions of the mergers, demergers will be happening now. We will have to relook into. For the existing 50B provisions, if you see, we used to calculate what is the book value, what is the net worth of the unit which is transferred, minus consideration, and minus is your capital gains. It is. And as per this, the definition of slum sale was concerned under 242C, which said the transfer of more or one undertakings as a result of a sale for a lump sum consideration. So the existing definition was transfer of one or more undertakings as a result of sale for a lump sum consideration. So what happened because of this definition? There were divergent views by the code. What did the code say? In case of a transactions where the money is not involved. So if I'm taking over some company, some unit, and against this, I am issuing the shares of my company, then in such cases, obviously, there won't be any goodwill because there is a transfer of undertaking not by a sale. If there is a sale, the consideration has to be by the money. The views were taken by Bombay High Court, Delhi High Court, and even Supreme Court in various cases. It says, if you read Bharat Biji, Bombay High Court, it said that the assessee transferred its lift division to another company in terms of scheme of arrangement under 391, 394 of the Companies Act, in view of the fact that consideration for said transfer was not determined by parties in terms of money, but its disbursement was in terms of allotment of shares, it was to be regarded as case of exchange and not a sale. And thus the provisions of 42C were not applicable. So in case of a barter, where the sum sale amount is not being paid by a monetary consideration, it is settled by a non-monetary consideration, such as issue of equity shares. Various courts as well that the 242C will not apply, that is, it will not be treated as sum sale, and it would not, this transaction would not be exigible to transactions, exigible to capital gains tax itself, which is in case of mergers. There were divergent views in this case also. There were certain Supreme Court judgments which have held that even a non-monetary consideration should be treated as a monetary and the existing provisions of tax should be applicable. So to cover up these divergence views, there is an amendment being made this time. The amendment has been made under section 2 bracket 42C, which now says, if you read the definition, initially it was transfer of undertaking as a result of the sale. Now it reads transfer of undertaking by any means. So there may not be any sale. Even if there is no sale, because a sale cannot be without a consideration. It says by any means, if you are transferring the undertaking and you are getting it in a consideration by way of issuance of equity shares, it would be covered. So now the internal restructuring happening with companies, wherein there was no tax impact. In fact, it was a tax neutral situation and it was only done to meet the efficiencies by merging, by bringing one unit under one particular legal entity would be now a problem and it would be a taxable under the slum sale. Another amendment which has been made in section 50B, other than definition of slum sale, is the under 50B bracket 2, initially, as per the existing provisions, the slum sale, in case of slum sale, there was no provision under the law to disregard the transaction value. Whatever was the consideration, whatever was the transaction value had to be accepted by the assessing officer. Now a provision has been made under 50B2 that in this case, a fair market value of capital assets instead of book value shall be considered. So if my transaction value is 100 rupees, and if the fair market value of those particular unit comes to 110, then the consideration would be treated as 110. Now, there were certain rules to be prescribed how this to be calculated. Rules have been prescribed only in the last month of the May. Budget was passed in March, so there were no rules. A new rule 11 UAE has been applied, which according to that, if you go into the rules, technically you have to calculate the value of the assets which have been transferred individually. So what is the value of the book values of the assets? What is the market value or the stamp value of the land? What is the market value of the other assets? So you have to individually assign those values, arrive at the value, and then compare with the transaction value. If the transaction value is less than this value will be treated as consideration. Now, this is against the basic principle of the provisions of section 50 capital B, which says that in case of the slum sale, there would be a lump sum consideration. And if the consideration is allocated under the various heads, technically, then there is a question of slum sale itself. So it may put to a question. So this rules actually goes beyond the provisions of the law itself, where the law says that it has to be a lump sum consideration. Now, for the purpose of calculating this lump sum consideration, you want to allocate to value to individual assets. Obviously, as we had discussed earlier, for the purpose of allocating the value of intangible assets, you may have to allocate some value to intangible assets also. But that would be limited only to the amount paid in excess. I may not revalue land, I may not revalue buildings. I will take over all the assets everything and only allocate the other values to any other commercial rights. So I only need to revalue goodwill. Whatever is not goodwill, balance is towards other commercial or similar rights. But this has come into picture. Another clause has been added in section 50 bracket 2, value of capital asset being goodwill, which has not been acquired by assessee by purchase from previous shall be taken as nil. This is similar to amendment made in 55(2)(a), so it has been included over here also. So what is the difference which is happening now after this lump sum? What if you see the current situation, if the amount received by the transferor is greater than fair market value, then in the hands of seller there was no impact, but in the hands of the buyer, excess consideration need to be recognized as a value for goodwill or other commercial right of similar nature. In case of depreciation, there will be no goodwill. There will be on goodwill there won't be a depreciation, but in case of other rights you can still treat it, and whatever goodwill you have paid will be treated as capital assets. If actual amount received by transferor is less than fair market value, then in case of seller, he will have to pay tax due to this dimming fiction, wherein the fair market value will be treated as a selling price. And in case of the buyer, short consideration if can be treated as a capital reserve, which will not be taxable. So there's no impact, but it will be treated as a capital reserve. This will apply from 2021. So if you, in nutshell, goodwill and this lump sum needs to be read together. There is a controversy. At one place, I can do a bifurcation, and you have stopped. If I do a bifurcation, the law says it cannot be treated as a lump sum. But the time will tell whether these rules will be actually upheld, because it is against the principles laid out under section 50. Another important provision is amendment which was made, and there are various issues which are in relation to this, which I would like to cover, is in relation to 45 bracket 4, which is in relation to dissolution or reconstitution of partnership. So there is an amendment made in section 45(4), has been replaced with the new section 45(4) existing, and a new section has been inserted, which is section 9 capital B. Now, why this has happened? This has happened because if you see the existing provisions, 45(4) actually stated that any amounts at the time of any amounts that which was received by the partners at the time of dissolution or otherwise, capital gains tax in the hands of firm only in case of transfer of capital. So if there was a transfer of capital assets on dissolution or otherwise, there was a tax liability under the heads of capital gains in the hands of the firm, partnership firm. But in case of reconstitution of retirement of partner, there was no tax on the capital gains. A lot of people have used this provision wherein the capital, the assets which were in the partnership firm were revalued and the amounts were credited to the existing partners. Then the existing partners used to retire, new partner used to come in, and their revalued capital was withdrawn by them without any tax. There was no tax because there were judgments to that effect that under 45(4) there is no tax liability when there is a reconstitution or retirement, because right on the asset of the partnership firm continues. So this, I believe, was not liked by taxmen, and there was an amendment made in 45(4), which is substituted, which says which is substituted and will be chargeable, has made chargeable to capital gains in the hands of the firm on receipt of money or capital asset by a partner representing his capital account balance on reconstitution. So now 45(4) has been amended to cover only reconstitution, not dissolution, which was existing. Dissolution has been covered in section 9 capital B. We'll see further. But now if any amounts is been received by way of money or capital asset by any partner, then firm has to pay tax under the capital gains. Capital gains tax will be chargeable in the hands of firm on receipt of money or capital asset by partner in excess of his capital account balance. As far as money is concerned, the consideration is in money terms, so no fair market value to be there. When partner receives any capital asset, a fair market value has to be calculated. And capital account balance of a partner will be deemed to be the cost of acquisition. So firm will calculate it, that whatever is the balance in capital account of the partner, that is my cost. What is the monies which have been received by the partner on reconstitution is my consideration, and the difference is taxed as capital gains. So this is how the calculation of capital gains will happen under section 45. Value of money received by the partners, add fair market value of capital asset received by a partner, less balance in capital account, without giving effect to revaluation of assets, self-generated goodwill, or any other self-generated asset. So it should be the real balance in capital account which has been created out of real amounts received, profits, or interest credited to that account. Not any revaluation notional entries should be considered while reducing this as a cost of acquisition. Before section 9B, there were judgments of Malabar Fishes which says only reconstitution of a partnership firm is not taxable to any tax or capital gains, because partners are not a separate, distinct legal entity when compared to a partner itself under the Indian Partnership Act. What it says is under the Indian Partnership Act, it is not a distinct legal entity apart from the partners constituting it. The firm as such has no separate right of its own in partnership assets. And when one talks of the firm's property or firm's asset, all that is made is property or assets in which all partners have a joint or common interest. If that be the position, it is difficult to account the contention that upon dissolution of firm's right in partnership, assets are extinguished. So 45(4), though there was a provision, there was a Supreme Court judgment which said that even on the dissolution, the rights of the partner does not get extinguished, because rights of a partner and a partnership firm are nothing, they are not separate rights, they are the same rights. So this was the position. Now 9B has been introduced. Why 9B has been introduced? That's very important, because 9B covers to tax income on receipt of capital asset or stock in trade by a partner from a firm or on reconstitution or dissolution. So 45(4) talks of reconstitution, 9B talks of reconstitution as well as dissolution. 45(4) talks of money or capital asset. Here it talks of capital asset or stock in trade. So capital asset is common over there. This covers both situations, but that 45(4) only covers the reconstitution. Now, question is, how do you calculate the income on receipt of capital asset and stock in trade? You have to take a fair market value. So if the stock is allocated, this happens in the builder's case when the unsold stock is distributed amongst the partners. So whatever unsold stock is there, that stock is distributed among the partners. Now this would be well calculated at the fair market value and would be taxable in the hands of the firm at the fair market value on the date of distribution, where the time of reconstitution or dissolution. So this would be calculated. There is an advocate provision made that there shouldn't be a double tax between 45(4) and 9B. That has been covered under that. The question is, what is reconstitution for the purpose of this? Reconstitution has been defined under section 9 capital B as following: one or more of its partners or members ceases to be a partner or member. So even if the one partner is retiring, it's a secondly, one or new partners or members are admitted. So even a single admission is so either retirement or admission of partner is covered. However, at least one existing partner or member should continue to be a partner or a member of the specified entity after admission. So it should not happen existing 5 partners are all going out and new 5 partners are coming, because that would be treated akin to dissolution. So what it says, that if one partner is admitted, subject to at least one of the existing partners is continuing, it will be treated as reconstitution. If there is no admission or retirement, but there is only change in the profit sharing ratio, even that would be treated as a reconstitution. So the reconstitution would be fall in all such reconstitution if there is distribution of any capital asset or stock in trade or money, then either the provisions of 45(4) or 9B would be applicable. How do you compute the income under the 9B? So it has to be computed at the fair market value. So transfer of stock in trade, it will be taxable in the hands of
wow, very good.
as a profit and gains of business income, or fair market value of stock in trade is recorded as sale in the funds. Computer gains as the transfer of capital. So as I said, there is an amendment made, a subclause 3 has been inserted in section 48 to avoid double taxation between 45(4) and 9B. And therefore, as per the computation under 9B, what it says, if any tax has been already paid under section 45(4) due to reconstitution been done, not dissolution, there would be that tax will be reduced as a deduction over here. So amount chargeable to tax has to be reduced. And the provisions and exemptions under section 54(54)(GB) will continue to be available in case of capital asset. But in case of distribution of stock in trade, it would be treated as business income, and those provisions will not be applicable. So just to recollect the position, this is how if there is a tax on transfer of money or property by a firm. I have discussed firm, but these provisions are equally applicable for 45(4) and 9B to association of persons and void wherein any distribution is made to members. So it's a partners or members. 45(4) taxability at time of reconstitution on income arising on receipt of money or capital asset. So reconstitution, money and capital asset. 9B taxability at time of dissolution or reconstitution on receipt of capital asset and stock in trade. So reconstitution being common at both the places, and capital asset being common. So if there is a reconstitution of firm, and on reconstitution there is a distribution of capital assets, both the tax will be applicable under 45(4) and 9B, but double taxation will not be applicable, will happen because of subclause 3 under section 48. I've just summarized the position, and this can be looked into it, how it would be applicable, in what cases 9B, what cases 45(4) be applicable, what cases both will be applicable. In case of retirement, you will see in case of retirement, money, capital assets. So this is to be later on looked into it. It would form part of my presentation material. What are issues that will arise now under section 9? The important issue which will occur. What would be the year of receipt of asset by partner? Because if you read the section provision, it says tax would be payable when there is a receipt of capital asset by partner. Now, if assets are received in different years, tax will be levied in those years. Does it mean that obviously if a certain asset is distributed in financial year March 21, then it is done in April 21? Does it mean that I have to calculate tax for different years? It looks like that because it is on receipt basis. How tax will be levied in case of dissolution? Now, section 9B says that firm has to be paid tax in case of dissolution. Now, firm is dissolved already on the date of distribution. When the partners receive any capital asset or stock in trade on dissolution, firm is already dissolved. So how will you tax the dissolved firm? Now, there is an advocate provisions under section 189, which says that firm will continue to exist for the purpose of the pending assessments for payment of the taxes. Of course, there is no specific amendment made to include provisions of 9B, but according to which section 189 will apply, and there is no need to have a separate fiction created for the purpose of 9B. And therefore, even in case of dissolution, for the purpose of taxation, you can take the department may take a resort to section 189 and still assess a dissolved firm on that basis. Another important, under section 9B, whatever capital asset or stock in trade is received by partners, the fair market value has to be taken. Now, there is no guidelines provided for the fair market value, which is in case of 50C, 43CA, which says that the fair market value will be calculated in a particular manner. You have to refer to a stamp duty value if it's an immovable property. If you go to section 56, there is a complete rules for 11 UA how to calculate the fair market value. There is no provision under section 9B, though it says it will be taxed at fair market value, but there is no provision how the fair market value will be calculated. Now, but of course, when there is no specific provisions, attention may be drawn to section 2(22)(b), wherein FMB has been defined. In those cases, in case of immovable properties, what will happen? There is no mandate for adoption of stamp duty valuation or guidance value. So, in case of immovable properties, fair market value will have to be calculated on the basis of the market rate and not on stamp value. So if stamp value is 100 rupees, which is important for purpose of 50C, 43CA, but in case of purpose of 9B, you will have to determine the fair market value based on the transactions which are happening at those area, and then calculate fair market value. Now let's take an example. In Mumbai city and Thane city, I am sure there are certain properties wherein the fair market value is less than the stamp duty value. So what will happen in that case? It says fair market value. So can the assessing officer replace the fair market value with the stamp duty valuations? This could be a litigation point, because I will take a fair market value. If you go to South Mumbai today also, and the fair market value is much less than the reckoner value, and therefore a lot of transactions are not happening due to worry of 50C and 43CA. Now, this worry will also apply in case of 9B transactions, where the asset has been owned by firm and is been distributed to the individual, where 9B would be applicable rather than 50C or 43CA. So, if the value is less than stamp duty, can it be replaced? According to me, it would be a litigation. But because there is no specific definition that how fair market value has to be calculated for the purpose of 9B, we may refer to 222B, which says the fair market value has to be calculated. If you can prove that the market value is less than the stamp duty value, I think so that it would be a good case. Another issue under section 9B. Now, under section 9B, it says in case of receipt of stock in trade, the tax would be payable under profits and gains of business. Right now, section 28, which is the main section for calculation, charging section for profits and gains of business operations, has not been amended to include stock in trade received by a partner on dissolution or reconstitution of firm. Now, once section 28 has not been built, can it be said because if you, after section 28, section 29 states that income referred to in section 28 has to be computed in accordance with section 3243D. So there are various deductions available against the income received under section 28. From that deduction, section 3243D is considered. Now, this amendment has not been made in section 28 to include those income which would be now chargeable under 9B. Though the other view is that there is a contrary view which is there in the professional circle, which says that section 9B subclause 2, subclause Roman 2 small clearly stipulates that income under the heads profits and gains of business will have to be computed in accordance with the provisions of Act. So once it says in accordance with the provisions of Act, then once I'm including this income in provisions of Act, then the provisions of 30 to 43 will be automatically applied, and all deductions which otherwise is available to me under section 30 to 43D should be available as a deduction under against this income also, because this is a normal business income. So whatever expenses I have incurred from 30 to 43D as a profits and gains should be allowable as an expenditure, though this is not included under section 28. So that would be a better view. Now, there is an issue under section 54C, EC. Now, 9B, in case of 9B, there is also capital gains tax payable. In case of receipt of asset of capital gains, this capital gains is payable at the time of dissolution, because on reconstitution, you are already paid under 9B, under 45(4). But in case of dissolution, no tax would be paid, supposing there is no reconstitution happened during the year. And only a dissolution has happened in its lifetime of a partnership firm. So the tax will be only payable as a capital gains under section 9B. Now the question arises whether a section 54 EC would be applicable, though it's a capital gains tax. In case of capital asset 9B, whether it can apply, whether you can get. The second question arises, when the firm is dissolved, how would you actually claim section 54 EC? Firm is already dissolved, asset has been distributed. Capital gains is calculated under dissolution of firm. By reverting to section 189, you may assess the firm. But how will firm actually invest in the bonds and hold it for a period of 5 years when it is dissolved? So how would you do it? So I believe that 54 EC can be claimed only in case of reconstitution of firm, whether it has been calculated under 45(4) or 9B. But in case of dissolution, which is taxable as capital gains, 54 EC will never be made available to you because of the dissolution which is happening. So this is a lacuna. So though it has been taxed as a capital gains under the dissolution, there won't be. Even after this amendment, the question regards the Supreme Court judgment of Malabar Fisheries, which says that on dissolution also, any asset which has been distributed, technically right do not end. If the asset is distributed in the same proportion in which their rights in the partnership firm was really there is a transfer of assets. So that question may still be argued. Issues under 45(4). Now it says the partner should receive money actually. Now question is whether credit to capital account amounts to receipts. So I am doing a revaluation of asset. I'm only crediting certain amounts to the partner. So whether it will be taxed on the credit of capital account or not, or it will be taxed when actually the money is received. Now whether credit to capital account amounts to a constructive receipt is a very big debatable issue. There are contrary judgments under the various other heads of the income tax that receive amounts, whether the constructive receipt includes constructive receipt. That is the question. So if the amount is credited, in my view, the receipt should be actually receipt of the money and not the constructive receipt. So though I may credit to the capital account, but the taxability should arise when the amounts are withdrawn from that capital account. So if the monies are credited to capital account at the time of reconstitution, but the amounts are withdrawn in the next financial year, a better view, according to me, should be that it should be taxable when there is a receipt relevant. Supposing the partnership firm is having an agricultural land. Now, agricultural land is not a capital asset. So if I'm distributing a capital asset on a reconstitution or dissolution, whether it would be taxable under 45(4) or 9B. According to me, it should not be because it's not a capital asset. So section 45(2), 45(4) does not apply. But what if it is as a stock in trade? Then it will be chargeable under section 9B because it will be chargeable. It may come out of the capital asset definition, but not in stock in trade. What happens when a partner dies and the legal head receives the amount in excess of capital account standing to the credit of the deceased partner? So any money received in excess of amount standing to the capital account is taxable in the hands of the partner under section 45(4) in case of reconstitution, and in case of dissolution under 90. The question is, if the partner dies, the amounts would be paid to legal head. What provisions of this apply? What the tax would be? According to me, if in absence of specific provision to this effect, legal heirs are not liable. According to me, under section 59 also does not apply as there was no receipt at all by the deceased partner. So what happens is, under section 59, in case of the death, the legal heir steps in the shoes of the partner, and it has been assessed in the hands as if it would have been assessed in case of deceased person. So the liability of legal heirs is only to the extent the tax assessment made in the hands of the deceased person. Now the question is, amount was not received by a deceased partner. So in the hands of the deceased partner, though the legal heir is assessed under section 159, it would not be taxed. So according to me, any amount received at the time of death of the person, the legal heir there should be no tax under 45 or 90. There are certain previous judgments also in particular case where the legal heirs have received certain amount on the death of a partner, and it has been held that these amounts are not taxable. Another issue. In the partnership firm, we maintain a capital account and current account. So we have a fixed capital, and whatever amounts is received over and above the fixed capital are credited to the current account. So the question is, while calculating the capital gains, whether I should also reduce the amount in the current account. According to me, it should be. What will happen in case of loan by partners? In case of LLP, we have a specific provision where a partner can give a loan, and the rights of that loan will rank with other lenders rather than with the other partners who have contributed to capital. So it has a better right than the capital because lenders will have a first right compared to the capital. So whether the balance in the loan account should be treated while calculating as a deduction, like calculating tax under 45, in my view, it shouldn't be. Similarly, there may be, in case of LLP, there may be provision in an LLP agreement that profits are not distributed to the partners and amount is carried to the reserve. Now, if there is a distribution out of the reserve, and whether if there is a distribution in capital and the partner is retiring or dissolving the firm, and that there is a distribution over and above the reserves, question is whether the reserves could be regarded as a payment in connection with the dissolution or reconstitutions. According to me, this is a very good debatable issue because the reserves technically is not a credit balance in the P&L account technically. So whether they should be reduced while calculating the capital gains. So this issue remains unresolved. Let's see what happens. We'll have to watch how the court takes me. So these are the amendments which were made in the latest budget and the issues around this. Now there are a lot of other perennial issues which based on the amendments made in last 2-3 years, which keeps on continuing. Now you may appreciate there has been always a lot of litigations and debatable issues have happened in case of landowners. And this happens basically in case of development agreements between a landowner and a builder on developer one side. So as soon as you enter into a development agreement, there is a registration of agreement done, and there is a transfer, a conveyance stamp duty is being also levied, wherein you actually transfer the right to build, right to construct, right to FSI, right to TDR, and you get in lieu of that either a birth monies consideration or certain area to be constructed, or the constructed area is also allocated to. There was a dispute going on that when would be the capital gains tax involved in case of that landowner who has transferred the right in the land against certain constructed area. So there were disputes. According to cover up these disputes, a 45(5)(a) was inserted 3 years, 4 years later. But unfortunately, this 45(5)(a) is only applicable to individual and HUF. On transfer of capital asset under specified agreement, such capital gains are chargeable to tax in the year which certification of completion is issued by competent authority. So in this case, based on 45(5)(a), in case of individual and HUF, the liability to pay capital gains tax has been postponed in the year in which certificate of completion is received and the constructed area allocated to you under that specified agreement is received. This has been done. Well, fine. Now, question is, what if such asset is transferred by assessee other than individual and HUF? So the debate continues, dispute continues. Whether gains are taxable in a year in which CC is issued by the competent authority. Now, there is a judgment of Kolkata High Court in case of Infinity Infotech Parks Limited, wherein it says there is no transfer within the meaning of section 247 would take place until builder has constructed said property and handed possession to assessee as per the agreement. So what happens is, Under the development agreement also, if you apply Delhi High Court, because individual and HUF 45(5)(a) ke baad clear, but before amendment there are still dispute going on. Kolkata High Court comes to your rescue, and it also comes to rescue in case of other assessors after 45(5)(a). I believe after 45(5)(a) there will be no disputes in case of individual and HUF, but in case of assessors we can place reliance on this by stating that transfer does not happen till the time I get the consideration by way of unit constructed. Now I will get the unit constructed only after the possession has been given. So till that time I do not get the value, the consideration which is by way of the constructed units. Therefore, the transfer is not contemplated or completed under 247, and therefore it should not be taxed. The same can be argued. Coming to another parallel issue of 47(13)(b), conversion of private limited company into LLP. So there are arises whether what 47(13)(b) has tried to propose that transfer of capital asset on conversion of private limited company to LLP is not considered as transfer if you fulfill the conditions provided under 47(13)(b). So in case the non-compliance, the exemption shall be withdrawn and gain arising on assets shall be transferred. What does 47(13)(b) says? That your value of the asset should be less than 5 crores. Your turnover in last 3 years should be less than 60 lakhs. So if you fulfill these conditions, there is no capital gains tax liability at the time of the conversions. Fine. Now there is a lot of debate been going on in this case that first of all, whether this transfer of capital asset on conversion of private limited company to LLP is at all a transfer. So there is a litigation, there is an issue, there are different views that on conversion of private limited to LLP, there is no transfer itself. It's a conversion, and conversion is not converted by transfer, it's conversion under the law. And once there is a conversion under the statute, there shouldn't be treated as transfer, and there shouldn't be a tax liability. So if there is no transfer, there is no capital gains tax itself, what is that has been done to what has been exempted? First of all, there has to be some tax, there has to be a transfer in capital gains tax, then there can be a provision to exempt it. So there is a view that technically there is not a transfer, but unfortunately there's a judgment, a very small judgment of a Mumbai tribunal, which says, if you see celebrity power, it says, celebrity power says solely it's a transfer because this is not under the statute. LLP Act, and it is not states. It's not like partnership firm being converted under Chapter 9 from LLP. You cannot compare to this. So this would be treated as transfer and it's taxable. But if you comply with 47(13)(b), then there is no tax. Now the question arises, let's presume that conversion of private company into LLP is a transfer. How will be capital gains tax calculated? Because all the assets, the capital gains can be calculated on the value of capital assets that are transferred. Now, all the assets are transferred at the book value. So my cost is my book value. My consideration is book value. Therefore, capital gain has to be nil. So technically, the provisions of computation of capital gains are rendered unworkable in the hands of the LLP or in the hands of the private company, which has been now converted. I'm transferring all my assets at the book value. Whatever is standing in the book company's trial balance of private limited company are converted, transferred into LLP at the book value. So there's no question of being taxed at all. So how would you calculate? Ultimately, the capital gain has to be nil. So this is what the issue is. And this issue has been also appreciated by celebrity power that there is not. But that still remains an unresolved issue. The gains will be taxable in the year of non-compliance. However, the issue still remains on how the gains will be taxable, how it will be taxable in the hands of shareholder. So in case of how the gains will be taxable, there are no provisions, if you see in this case, that the fair market value should be replaced for the purpose of consideration. Now, if it is transferred at book value, the consideration has to be done. So no tax liability in the hands of the company. Now, what happens in the case of shareholders? There is no clarity yet. There is a view that it may be taxable at the of the shareholder, because instead of the shares, those shares rights in the company are getting relinquished, and the amounts equivalent to that value is getting credited to your capital account in the books of LLP. So your shares are now getting converted into a capital balance. So there is a consideration by way of capital account balance. There was cost of the shares, and therefore it would be taxable in the hands. But how it would be taxable? What would be the indexation in the hands of shareholders? what would be the value that will be taxable? If I do an index on the capital value, whatever amount has been credited to capital, that means the difference in the reserves in the company's account, which will actually form an appreciation to my capital over and above my cost of shares, would be taxable. But this remains an unresolved issue, and therefore this movement from private company to LLP has not moved much. And now, in any case, a lot of people have stopped doing that because the private companies have already now suffering a lower tax rate of 25.17 blended tax rate compared to LLP, which has now been almost taxed at 35%. 54 EC rate with section 50. Generally, we have seen in case of depreciable asset, section 50 is applicable. And whatever amount is received as consideration, you credit it sale consideration to the block of asset. And the block continues. In case the block gets completed, there is a capital gains tax. Now, the question arose before the Bombay High Court that whatever amount the block is complete, let's take my block has a WDV opening WDV of 50 rupees. I sell an asset of 100 rupees. So this 50 rupees is technically taxable under the short-term capital gains. And the taxes was paid. Now the question arose that whether this capital gains, I will get a benefit of 54 EC, which is otherwise available only for a long-term capital asset. The Bombay High Court in case of Ace Builders stated that though for the purposes of calculation of capital gains, section 50 is prescribed and it is only for the purpose of applicability of calculation of tax in case of depreciable asset, but the asset remains a long term. If that particular asset was held, if any asset in that particular block was held for more than 2 years period, then it becomes a long-term capital asset. And therefore, once it is a long-term asset, the deeming fiction provided under section 50 cannot be extended to other provisions of the law. Deeming fiction is only restricted to mode of computation of capital gains, does not apply to other provisions of it. And therefore, section 54 EC will be available on sale of depreciable asset. So now this goes me to, I've seen it during my regular work that a lot of us, by calculating this capital gains, in case of block assets, we are offering to tax as a regular short-term capital gains and tax is being paid at 30%. Now, if this analogy laid down by Bombay High Court in case of Ace Builders, that in case of a depreciable asset, 54 EC is available, why not the amounts, if I'm not investing in 54 EC, but the charge of the capital gains tax should be also what is the rate available under section 112, that is 20% and not 30% in case of individual firm. In case of company, not 20%, but 25%. So according to me, there is a Manali Investment Mumbai Tribunal which has relied upon this Bombay High Court. It says asset remains long-term capital asset. Though it is part of the block and you have claimed a depreciation, but the asset remains a long-term capital assets. And on the sale of assets, the rates otherwise liable under section 112, which is applicable to long-term capital assets, would be only taxable. So your tax rate would still remain 20%. So it's a very important point. But there is an issue with the form itself now. If you go into the form ITR, if you reduce the value, what happens is, if you fill the WDV chart, and if you reduce the sale consideration from a block of assets and the excess amount is available, that excess amount is automatically goes into a short-term capital gain. And the system, the software itself calculates to a full tax rate instead of tax rate under 112. So there is a practical difficulties what is happening. And most of us practicing chartered accountants, I know 80% of them are paying full tax rates, which is otherwise applicable to short-term capital gain, and not tax rate, which is 20% under 112. So only thing what you can do while filing the return of income, whatever is amount available as an opening balance in WDV, only that much sale consideration should be mentioned in the block. Balance would be nil. And the excess received over and above, which is taxable as long-term capital gains, should be reported in long-term capital gains schedule with nil cost of compensation. Then only your software will calculate 12%. Otherwise, 112 rate, that is 20%. So you may have to do it, but this is a correct view and we should do it. Though the issue remains as far as the returns are concerned, you are not able to calculate. So you may have to do some jugglery in that. But that is, jugglery would be correct in view of the law that is prevalent. Another important definition which is in relation to non-residents. Definition of liable to tax. As you know, there was an amendment made in Finance Act 2020, wherein a new section 6(1)(a) was introduced, and there was a lot of controversy. And the finance minister had to come to the foray come to the newspaper and gave a statement that they do not propose to tax the world income of non-residents. There's no such income. But and therefore a clarification was included. 6(1)(a) was amended, and 6(1)(a) was only made applicable in case the total income exceeding INR 15 lakhs is earned in India. So what did the 6(1)(a) actually say? 6(1)(a) said actually Indian citizens who are not becoming a resident under Section 6(1) may still be considered as a deemed resident if his income in India is more than 15 lakhs, and such person is not liable to tax in the other country. So the last line of my presentations. What it says, Indian citizens who are not resident under 6(1), I'm not resident under the 6(1) because I'm not staying in India for more than 180 days. I'm outside India, and still I may be considered a deemed resident if my income is more than 15 lakhs and I am not liable to tax in any other country. So I was a deeming provisions. Based on this liable to tax, the definition of liable to tax has been inserted this year to make it more clarification, but it's a retrospective amendment which is coming from 1st April 2021 financial. It says liable to tax in relation to person and with reference to a country means there is an income tax liability on such person under law of that country for time in force and shall include a person who has subsequently been exempted from such liability under the law of that country. So the question is, if you read liable for tax, you should be liable to tax under the law of that country, though you are not paying actually tax due to some exemption otherwise available to you. So once you are liable to tax in another country, then obviously provisions of 6(1)(a) does not triggers. 6(1)(a) triggers when you are not liable to tax in any other country. Basically, there are people who do not become resident of any country. They keep on moving. They are 90 days in India, 90 days in UK, 90 days in Dubai, 90 days in Russia. So they, under any of its residential provision, they are not liable to tax in any other country because they are not resident anywhere. So to cover up those type of payers, 6(1)(a) was inserted, stating that he will be treated as deemed resident if he is an Indian citizen. So if I am an Indian citizen and I am not resident of any other country, including India, I will be a deemed resident of India, subject to 15 lakhs of income. But there was some saving grace did after a lot of hue and cry. A saving grace was needed that even if you become a deemed resident under 6(1)(a), but you will be treated as resident but not ordinarily resident. So you will be treated RNOR. That means your world income would not be taxable unless and until those business income is there, which is actually controlled or run in India. So your status was converted from resident, because once you become a resident and you are treated as ordinarily resident, then your world income is taxable. So there was a clarification issued and amendment was made in the section subclause 6 of section 6 brackets 6 subclause 6 section 6. So there was a definition that such 6(1)(a) cases would be treated as RNORN. Now still there are a lot of implications which are clear. So change in basis of classification of resident. Now, so there is a change which has happened in 6(1) also, including 6(1)(a) and 6(6). There is another change of 6(1)(a) which says an additional condition has been introduced on classification of citizen of India or person of Indian origin where following criteria become resident under section 6(1). Total income from foreign sources should not exceed 15 lakhs. So my foreign sources income should not be 15 lakhs. My total stay in India during the year should be more than 119 days. And the period of stay in immediate place should be 360. So if it is more than 119 days, so there is an additional condition. This was reduced from 181 days. If you read clause number 1A again, you will be treated as RNOR. So my main implication is what will be implications once you are treated as RNOR under the deemed resident. Only Indian income is taxed in India, as section 6(1)(a) is applicable only if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria. Reason of his domicile or residence or any of similar means not qualifying as resident of any country and consequently not liable to pay tax in any country. So in case, if you take a case of UAE, if I'm subject to tax under the local laws, but I'm not paying tax because of exemption, that does not mean I'm not liable to tax that. So I'm liable to tax that. So if I become a resident of that particular country, even if I'm not resident, I will be still subject to tax, liable to tax in that particular country because of my residential provisions. What would be impact? Though I have been shifted from resident to RNOR, but there will be still consequences will follow. So he will have to file a return as a resident. Once I am filing a return, there will be increase in scope of total income. So because there is a difference between residence and RNOR as far as scope of total income is concerned. I lose all the exemptions. lose concessional rate of tax, which is otherwise only available to non-residents. Benefits provided under DTAA will be lost because now I am a resident for the Indian. I will have to report foreign assets. Generally, non-residents do not have to report foreign assets. But once I become a deemed resident, though RNOR under 618, I will have to report that. That will be increased onus to substantiate non-taxability of income and uncertainty in rates. So this could be a possible impact which will continue because of this deeming provisions coming in from 618, and I am becoming RNOR, which otherwise I was a non-resident. Other perennial dispute, I don't know whether that dispute has tried to be resolved or has been more aggravated. Now, there are issues. 36(1) small Roman 5a is in regard to payment of employees' contribution on or before due date. So let's take an example. If employees' contribution is not deposited before the due date prescribed under that particular law, there was a disallowance permitted. Now, there were judgments to this effect that in case this amount is actually deposited before due date of filing the return, then the provisions of 43B are applicable, and therefore this should be allowed. There were the contrary views. If you see, even the 143(1)A adjustments, prima facie adjustments have been started made, wherein even if the tax auditor is reporting that there is a delay as under that particular law, though I am not disallowing in the computation, you will receive 143(1)A, wherein the disallowance of the employee's contribution is already been done. Now, to overcome this judgments, I believe a clarification, explanation has been come under 36(1)(5)A and 43B, which says the wordings of application, if you read the explanation, the wordings of the explanation indicate that clarification is retrospective in nature. However, in the memorandum of budget, it has been mentioned that said amendment will apply from assessment year 21-22 and onwards. Accordingly, there still exists a gray area as to whether existing litigation will get the benefit of various tribunal court rulings or benefits will be denied due to such an amendment. If you read the it says that it is to clarify. Once if the explanation says it is to clarify, there have been judgments at various places wherein such clarificatory explanations has been treated to be retrospective applicable. So whatever appeals are pending or whatever adjustments have been made in 143(1) and you are disputing by way of filing a rectification applications or appeal, whether this, after coming of this explanations, the department will argue that this is a clarificatory in nature and therefore retrospective, and those disallowance will happen. Or you will still be benefited by the judgments of Bombay High Court and Karnataka High Court, which have held that employees' contribution will be allowable and is covered under 43B if it is deposited before due date of filing the return. So this issue will remain. My view would be that we should keep on litigating it, because once though the explanation is, it is actually increasing the burden of tax. Once the burden of tax has been increased, it cannot be retrospective. So it says that it's a clarificatory nature, but the department is not going to agree. Department is in any case making an addition irrespective of the amendment. But after an amendment, after insertion of explanation, one can also argue that it shows the department is aware that in fact the finance ministry is aware that this was not covered initially by 36(1)(5)A and 43B was applicable. By putting an explanation, they have accepted it that from this particular date, which says specifically this amendment is made from assessment year 21-22, and therefore only for this particular financial year it would be disallowed. Earlier years it should be allowed. A new process, a new history will start now. The most importantly, the time to see what will happen. There are a lot of, I keep on receiving theories from the people that now the new procedure for reopening of cases have come under section 148 capital A, which is effective from 1st April 21. And we are receiving the notices under section 148 without following the procedure under 148 capital A. So what should we do? What would be the status, whether these notices are valid, invalid? Time will tell. But let us, before going into that, let us understand the provision of 148A, which has come. What does the 148A says? Assessing officer, before issuing the reassessment notice under 148, need to follow the procedure under section 148. So what is basically the procedure? Before issuance of notice under 148, nowadays you will find you directly receive a notice under section 148. There is no communication between the assessing officer and the assessing before the issuance of notice. But 148A now says that there should be this procedure should be followed. What is the procedure? conduct an inquiry. So before he has to issuance of notice, he has to conduct an inquiry in respect of the information available with the assessing officer, which suggests that the income chargeable to tax has escape assessments. So after whatever information is available, which is suggesting that income has escape assessment, he has to take a prior approval of specified authority and conduct an inquiry. After conducting an inquiry, opportunity of hearing has to be granted to the assessee, and a show cause notice has been issued stating that I propose to reopen the case. Now, this opportunity of hearing is also after the taking prior approval of specified authority. In response to that, obviously, assessee will reply, and after considering the assessing reply, he is expected to pass a speaking order, and this speaking order will be also after the approval of specified authority. So before issuance of notice under 148, now there will be a 3 times approval of specified authority. First, before conducting an inquiry, then before issuing a show cause notice, and then after receipt of reply, after receipt of reply and before issuing the final order in respect of issuing the notice under 148. So there is quite a safeguard when an approval of specified authority has to be taken. And there is also an opportunity available to assessee to explain its case that why the information do not suggest that there is an income escapement assessment. So this procedure is fine. Now, following condition needs to be clarified for the completion of reassessment. Any income chargeable to tax as escape assessment for any assessment year, and AO follows the provisions of 148 to 153. These are the provisions of 147. For the purpose of 148, issue of notice for review. In case other than search, survey, or requisition, explanation 1 to 140, information shall be deemed to be suggesting that income chargeable to tax as escape assessment. Now, so what deemed to be suggesting? That means in case of search, survey, or requisition, there is no formula to conduct an inquiry or write a note on that, take an approval technically, because it is a deeming suggestion that the income, once a search, survey, or requisition has happened, it will be deemed that there is a suggestion that income has chargeable to tax as escape assessment. In case any information flagged accordance with the risk management strategy, any final objection raised by CAE. Now they are talking, whenever there is an information which is flagged accordance to risk management strategy and there is a search survey, it would be deemed to be treated as a income escapement. Now there is no clarity on what this risk management strategy is. Secondly, this now 148 provision will also apply to all search that takes place after 1st April 21. You may recollect that for the purpose of search, survey, or requisition, the assessment is made under section 153A to 153C provisions. Now this will be discontinued after 1st April 21. Wherever the search takes place after 1st April 21, now for reopening the cases, the assessing officer will have to resort to section 148. And once there is a search, survey, or requisition, it will be deemed to be income chargeable to tax. And therefore, naturally, your previous year's cases will be reopened. Though there is a procedure under 148A, there is an exception given in case of search and requisition cases, wherein they can directly issue a notice under 148. There's no need of following the procedure under 148. Once there is a search, you issue a notice. That's what the provision 148 is, amendment. So 148A, the procedure we have said, this procedure do not apply in case of survey, and the survey has to follow the lay down whatever before issuing. Does not apply only in case of search. In case of survey, he has to follow the procedure under 148. Then there is a time limit for reopening of the cases, which was hitherto 4 years and 6 years. Now it has been reduced to 3 years from 6 years. But in case of serious tax evasion, it has been increased technically from 6 to 10, I would say, because there is a 2 limits, 3 up to 3 and 3 to 10. What is serious tax evasion according to them? When AO is in possession of books of accounts or documents or evidence which reveal that income chargeable to tax represented in form of asset, which has escape assessment, is 50 lakhs or more in the year, 10 years after approval of principal. So now the reopening can be resorted up to 10 years in case the income chargeable to tax has escape assessment and is represented in form of asset. Very important. Form of asset. That means if I have incurred some expenditure, unexplained expenditure, and that is not represented in form of asset, then obviously, then the provisions of serious tax evasion will not have. If there is only unexplained asset or unexplained investments, then only because it has to be in the form of asset, then the serious tax evasion provision will apply, and it can be increased to 3 to 10 years. So if I see actually the time limit has been increased because 50 lakhs has no value today. Now, this extended period of 10 years was available only in case of search cases wherein the similar provision was there, when there was a serious tax evasions in form of asset amounting to more than 50 lakhs, then in case of search, you could have gone to 6 to 10 years. Now, in all cases, you can go up to 10 years, not only search. In the 153A, you could have gone to 10 years. This amendment was brought 3 years back. Now, by this amendment, in all cases, you can go up to 10 years if the tax evasion is more than 50 lakhs. Only rider is form of asset. There is a sanction authority under section 151, which says we have seen that you require prior approval of specified authorities. Now, there were a lot of other different authorities up to 4 years and 6 years up to before 31st March 21. Now, from 1st April 21, up to 3 years, the commissioner rank or director or commissioner rank is the specified authority for taking an approval. And more than 3 years, it's a chief commissioner. The main important point is, if you see, initially there was under section 151, satisfaction was required of the specified authority. Now there's no need of satisfaction, it's on approval. The question will apply. There are a lot of judgments which says that satisfaction should be application. It should show the application of mind. A mechanical satisfaction or non-application mind was not sufficient. Now the question arises, only approval and authorities, this satisfaction has been replaced by approval. So whether judiciary would actually interpret the word approval similar to word satisfaction and seek that there has to be application of mind, it shouldn't be as the time will tell. But according to me, even the approval will hold similar waters and it should be similar to the satisfaction and the whole judgment should be applicable. So I've just given this comparison of the existing procedure and amended procedure. Of course, the amended procedure is good. You get a lot of time under 148 in the normal courses. And though there is, if the existing procedure of 4 to 16 years has now come to 3 to 10 years, 16 years was available in case of foreign assets now. Now, even for foreign assets, it will remain 3 to 10 years. So this is an important slide, which is, according to me, there is an existing procedure as well as amended procedure. Existing procedure reason to believe more than 4 years, failure on the part of assessee, foreign assets reopening up to 16 years, which has been now changed. This is an existing procedure. Amended procedure, the more than 4 years failure on the part of assessee, up to 3 years only. There's nothing called failure on part of assessee. It has gone. In case of foreign assets, also now it can be only opened up to 10 years or 3 years if the value is less than 50 lakhs. So reason to believe is not there. The continue under the new change in opinion, according to me, shall continue. Income escaping assessment, jurisdictional AO cannot reopen for verification and making fishing and roving inquiries. Recording of reasons is replaced, but now the 148 procedure by way of passing an order would be as good as recording of reasons because the order has to be speaking, I'm sure. Issues related to service of notice under 148 will still continue. Approval of specified authorities is continuing. So that may be requires application of mind and procedure of amendment. Now the issue that arises is, now this has been passed as on 31st March 21, 28 March 21 budget, which is applicable from 1st April 21. Now the question arises that whether the new provisions prescribed under 148A would be applicable for all notices that have been issued after 1st April 21, though it is applicable to assessment year 7. Now, there are two views in that. It takes me to two judgments of Karim Frovi Tea Estate of Honorable Supreme Court 60 ICAI 262 and Sri Chaudhary Transport Company, which is the latest judgment of passed in 2018, wherein it has been held that it is a well settled that Income Tax Act as it stands amended on the first day of April of any financial year must apply to assessments of that year. Any amendments act which come into force after the first day of April of financial year would not apply to assessment for that year, even if assessment is actually made after the amendments come into the force. So technically what it says is that the amendment would be applicable assessment year wise. Though the amendment has been made after 1st April 21, it will only be applicable to assessment year 21-22. It will not apply to assessment year earlier. So if I have to issue a notice of assessment year 16-17 today, during assessment year 16-17, reopening provisions contained reopening up to 4 years or up to 6 years. So 17, according to assessment year 16-17, can be reopened up to end of March 23, that is 6 years. Similarly, and similarly is the case of Sri Chaudhary Transport, wherein 40A1A came for the first time from the 1st April 2005 assessment year, and this Finance Act of 2004, because of the elections during that time, was passed in September 2004. So financial year 4, 5, 6 months were only elapsed. So it was been challenged that it should not apply for 4, 5 financial year because the 6 months have been already elapsed. Like in this year, certain provisions are applicable for FY 2021, though it has been passed on 28 March 21. Supreme Court said, sorry, it will be applicable from assessment year 5-6 for the whole assessment year, irrespective, because it is applicable to that particular assessment year. So coming in this view, a question will arise that even for assessment year 17, 18, 18, 19, the provisions of section 148, 147 will be applicable, which stood during that assessment year and not when the notice has been issued. And the second view is that this being the procedural provisions, provision under 148 capital A should be followed. So a combined view which is coming is that the procedural provisions of 148A should be followed after 1st April 21, irrespective reopening for which year it is happening. But you can resort to reopening beyond 4 years and 6 years because you are reopening assessment year 16, 17, and during that period, though assessment years were opening, though there is saving that you cannot go beyond a particular year, though the time has extended from 3 to 10 years. So there is an advocate provision made under 149(2) that because the time has been extended from 3 to 10 years, but the assessment year 12-13 is already expired before passing of this Finance Act, that cannot be reopened under the amended provisions. But there is no provision for that. So according to me, the previous assessment years will continue to open. But the question is whether a 148A provisions will be applied. This has been debatable. Of lately, we have come across a Bombay High Court judgment writ petition, which has stayed the notice. A notice was issued on 7th April 21, and the procedure under section 1 was issued under section 148 without following for the assessment year 1340 on the ground that respondents have violated the mandatory provisions of issuance of notice which have been effective from 1st April 21. So though the judgment has not been passed, only the proceedings of assessment has been stayed. So we'll have to wait and watch that all the notices which have been issued under after 1st April 21, which has not followed the procedure under 148 capital A mandatory, whether those notices will be treated as valid under the law. The judgment will come. As of now, we have a Bombay High Court judgment writ petition which has stayed the proceedings of reassessment, and reassessment procedure has stayed. And as and when we come to the judgment, we'll come to know what happens to that. Meanwhile, obviously, when we are taking, though we are every person, every assessee cannot file a writ petition. According to me, whenever you are responding to notice under 148, which has not followed the new procedure after 1st April 21, you should take objection on record. Please keep the objection on record, which will be very helpful at the time of the assessment to challenge that. 206C, 1H, and 194Q, TDS and TCS. We were deducting TCS, collecting TCS. A seller had to collect the TCS if he was selling more than 50 lakhs of goods to any particular buyer during the year and his turnover was more than 10 crores. Now 194Q has been inserted. According to them, a TDS has to be deducted by a buyer if he is selling more than 50 lakhs, if he is buying more than 50 lakhs goods from a particular seller and his turnover is more than 10 lakhs. So once the TDS has been deducted under 194Q5, it says provides that no tax is required to be deducted by any person unless provision of tax is deductible under any other provision of taxes collectible under 206C other than 1H. So 194Q will prevail because it says tax is not required to be deducted only if tax is collectible under these sections 206C other than 1H. So if tax is collectible under 1H, still 194Q will be applicable. So the first instance would be a buyer would deduct TDS. And if the buyer is deducting the TDS, then tax is not to be collected under 206C 1H. There is already an existing application. Exclusion is available under 206C 1H. Now the question may arise, if the buyer's turnover is less than 10 crores, then obviously he will not deduct TDS. So in such cases, seller will have to collect TCS. If the buyer turnover is more than 10 lakhs, then if you see an example, so there is a lot of scenarios. If the buyer turnover is more than 10 lakhs, he will be collecting a TDS. So in that case, I don't have to collect TCS. So now you will have to take a deductions when the person is selling the goods. I think so you will have to take a declaration from the buyer that whether his turnover is more than 10 lakhs, whether he would be deducting TDS or not. If he's deducting TDS, I will not collect TCS. If he says, no, my turnover is less than 10 lakh crores and my provisions of 194Q are not applicable, so I'm not deducting TDS, I will correct. So there will be a declaration. So a lot of procedural provisions will change effective from 1st to the and we need to look into this. We need to ensure that assessees, our clients, do actually apply these provisions of 194Q and 2061H properly. Corporate tax rates in India, I thought I will just cover up. We all know there are various tax rates for specified companies, up to 1 crores, 1 to 10 crores. We have a different tax rates. If you remember, there are tax rates available now. It's 25.1.7 if you opt for section 115 DAB. If you do not opt for 115 DAB, then 22%. All tax rates on the screen are including of surcharge and education tax, and therefore the slabs have been made based on the taxable income. So if for the newly incorporated companies, there's a 15% tax rate plus surcharge. If you take an option, you have a 22% plus surcharge. Now there is a one clause which says, what's an issue in this important is, so very simple, that there is a one clause that if I am not opting for section 115 DAB, then I have under the regular tax. Now the question is, under regular tax, whether I have to pay a regular 31.2 tax rate, 31.2, 30%, or I have to pay 25%. Now there is a clause which says if the domestic company is having a gross turnover up to 400 crores in financial year 17-18, then my tax rate would be 25%. So I don't have to pay 30%. So though I am not opting for 115 DAB, I'm not going for 22%, I'm not in 15%, but I still can be into 25% if my turnover of 400 crores was less than in financial year 17-18. So that continues. Otherwise, I move to 30%. Now the question is, what happens to the company which have been incorporated after 1st April 18? Of course, my turnover during 17-18 will nil in that case. So what would be the question? There are different views. Of course, for the newly incorporated companies, as would be adopted as a nil. According to me, you will be taking as a nil. So according to me, if that company was not incorporated during the financial year 17-18, it was not applicable, then you will take a nil value. Once you are taking a nil, and then nil because it was not incorporated, that means your turnover is less than 400 crores. So even under the normal provisions, you would be only liable to 25%, and all benefits which are available to a company which is not opting for 115 DAB, concessional rate of 22% will be available. So the companies whose turnover was less than 400 crores in 17-18 can still continue with without an option, take a 25%, claim all various depreciations, other 80IB benefits what are available. Deemed dividend 222E has become an important after it came into a tax audit report, according to me. Initially, nobody was looking into it. But now, as an auditor, you have to report any transactions which are covered in the 222E, and deemed dividend is applicable. What does 222E says? Any advance or loan by a company to a shareholder who is holding more than 10% of voting power, or advance or loan by a company to another entity where the individual shareholder has substantial interest, that is more than 20%, or any payments made on behalf of individual benefit of the shareholder, that will be considered as a deemed dividend to this extent of accumulated profits. Now, this accumulated profits is a big issue because I have to report in my tax audit how to calculate accumulated profits in case of the company, whether the accumulated profits of the parent company, whether it has to be calculated on date when I am giving a loan or advance. It is very difficult to identify payments made on behalf of shareholder. I am making an LIC payments to the shareholder. How you do it? Whether accumulated profits which can be distributed and which cannot be distributed needs to be bifurcated. So there may be some accumulated profits which cannot be distributed. I transferred it to general reserve, which cannot be distributed under the Companies Act. So ones which cannot be distributed, whether I should take that into consideration. So there are a lot of issues around this. And when I have to report in the tax audit, obviously I need to have an answer to all this. So how should I calculate possession of accumulated? There are a lot of judgments which says how the accumulated and profit should be calculated, what should be included and excluded. So according to, there is a Supreme Court judgment which says accumulated profits shall be commercial profits and not assessed income. So profits as per the book should be taken. Then there is a judgment which says profit under section 41(2) is not part of accumulated profit. So any credit balance written back, any liabilities written and tax under 41(2) should not be treated as part of accumulated profits. Share premium should be excluded from accumulated profits, Mumbai Tribunal. Amount treated as deemed dividend in past shall be excluded while determining. So if there is already a deemed dividend been taxed in the hands of the shareholder in the earlier past, though actually there is no dividend distributed. In the books of accounts, you have treated it as a loan, but the income tax authority has treated as a deemed dividend and been taxed. then the accumulated profits which are there in the balance sheet should be reduced. The deemed dividend which has been already taxed should be reduced, and then the accumulated profit should be arrived. Because if the same accumulated profits cannot be every time, whatever loans you give, whatever advances cannot be taxed again and again because you have an accumulated profits available. You will have to maintain a memorandum book that these are the accumulated profits. Whatever amounts has been taxed as a deemed dividend or reported in your tax audit report should be reduced and then recalculated accumulated profits. Who is to be taxed? See, deemed dividend is taxable in the hands of the shareholders. It's not taxable in the hands of the company. We are the auditors of the company. We have to report what are the amounts in the transactions of nature of deemed dividend. But there will be no adjustment in the computation because it will be ultimately taxed in the hands of shareholder. The question arose before Supreme Court that whether the registered shareholder or beneficial shareholder will be taxable. In case of, just took an example of HUF, the shares actually stand in the name of the Karta. So whether it should be taxed in the hands of Karta or HUF, Supreme Court said it should be a beneficial holder. So in the hands of shareholder. How to be taxed in case the loans have been given by one entity to another entity? Between two corporates, there is an advanced transactions. Of course, ICDs are not covered, there are judgments, but there are transactions between company A and B, and they become an associate enterprise due to the definition provided, wherein there is a common shareholder. In one company, same shareholder is holding 20%, and in another company, there is a 10%, and there is a transactions which is in nature of 222E. Then how the tax has to be calculated in the hands of the individual? Whether, because the total dividend advance may be given 100 rupees, whether it should be taxed in the hands of all the shareholders. If there are two shareholders who, because of whom this dividend has been attracted, according to me, it should be divided equally. It cannot be that only one common shareholder be taxed. If there are more than two, then the both common shareholders should be taxed, and it should be divided on a proportionate basis. So those issues remain. There are judgments in this regard which have been listed in this slide, which says that it should be on a proportionate basis. Loans, ICDs are not covered. Advances made in ordinary course of business are not covered. Transaction in are not covered, but there are contrary judgments. Bombay High Court says that it may be covered in certain cases, but the journal entries may not be covered. Delhi High Court says. So if there are current account transactions, I am paying duty on behalf of somebody, tax on behalf of that, it should not affect the dividend provisions. 14A, which really does not matter so much now, but I thought I will just give this, that because 14A, there is no exempt income nowadays. 14A was more or less invoked when there was dividend was exempt and the long-term capital gains were exempt. Now both are taxable nowadays. So there won't be a situation in case of share trading 14A, but there will be some disallowances when there is some other exempt income. So there may be an exempt income by way of profits received from a partnership firm. And if you have incurred some expenditure, that should be disallowed. But the satisfaction of assessing officer is first. We may not, if the auditor is not reporting any expenses, he is not allocating any expenses, that does not mean that you have to, because the under 14A satisfaction of AO is must. That's what Bombay High Court says. No disallowance, there cannot be any disallowance of interest where there are sufficient own funds. So if I have an own funds and borrowed funds, then there will be a presumption drawn that the own funds have been used for making an exempt investments. There are various judgments of Bombay High Court in this regard. Expenses to earn net interest should be calculated. If I have an income and interest income also and expense also, a net should be treated. Now question arises whether I'm not earning any exempt income from a particular investment, whether I should apply 14A. According to me, no. Only in the year when those income is received and you're claiming an exemption, it should be provided. The various no disallowance can be made if no exempt income earned. So only if the exemption is claimed, disallowance should be made. Conversion of stock in trade of capital asset, an important issue. There was an amendment made in assessment year 1920, 2868. We all remember, if the capital asset is converted into a stock in trade later on, the capital asset, then there is a two-way working done. Up to the date of conversion, the amount is taxable as capital gain, and the gain above and above that value is taxable as a profits and gains of business on the stock in trade. But the amount of tax has to be paid when actually that asset is sold. Unfortunately, an amendment has been made in 26A where it says that if a stock in trade is converted into a capital asset, it would be treated as profits and gains of business, and on the fair market value of that amount on that particular date would be treated as a consideration for stock in trade, and it would be treated as sale of stock in trade, and tax would be payable. Now, this provision actually taxes the notional income because I'm not selling stock in trade, I'm only converting it to a capital asset. That could be a deferment of a tax, that the business income should be taxed when ultimately I sell a capital asset. So up to the date of fair market value, similar to the provisions available under capital gains, I should pay tax when actually I realize. But unfortunately, it taxes the notional income even on the conversion. So whenever you are converting stock in trade into capital asset, as per 26, it's taxable at the time of conversion itself. Though there is no amounts been received, there is no asset been realized. So on the notion, it is against the real income theory, which Supreme Court has upheld a lot of time. The important issue that now comes is 37(1). That is contrary views. All the corporates have to do a CSR expenditure. An explanation was added to section 37(1), stating that expenditure incurred in respect of CSR covered under Companies Act so and so, is not allowable under section 37. Now the issue that arises is, as part of a CSR activity, I give a donation which are eligible as a CSR under section 135 of Companies Act to an institution who is registered under ATG and issues me a receipt under ATG. Question is whether I can claim an ATG. A lot of people are not claiming, I've been told, because they say that the expenditure of CSR is not allowed. Now the question is, section 37(1) deals with an expenditure. It is only applicable to expenses which are claimed under the section 37(1). Explanation 2 is to section 37. It will not apply to other provisions. According to me, even if the CSR expenses, CSR done under section 135 of Companies Act by way of donations made to an institution who is issuing an ATG receipt, it should be allowable as a deduction under section ATG, or it should be deduction all CSR expenditure which are otherwise allowable under any other heads from section 30 to 43, rather than except 37(1) should be allowable if it is, though it is covered under CSR, because this explanation should apply under 37(1). But that's issue remains, time will resolve it. There's a judgment in case of GNBSL. Of course, this judgment was before this explanation was inserted, wherein the assessee, it's a government entity, GNBFCL, and they had made donations to educational institution, trusts, local bodies for discharging its CSR responsibility. Same was to be allowed a deduction under 37(1). Now, there are judgments which says it would be allowable under 37(1) because it's a corporate social responsibility. But this was before the explanation was infected. Now the question is, what happens if I do not claim as a CSR under Companies Act? That means if this explanation only restricts if you are claiming CSR under section 135 of Companies Act. If any entity who is doing similar expenses, donations, let's take a partnership firm who is not required to otherwise do CSR under 135, but I'm doing CSR as a matter of pride, as a matter of giving back to the society, then according to me 37(1) will be allowed. 37(1) explanation only restricts when you are claiming benefit under 135 of Companies Act. So according to me, if you are not claiming a CSR benefit under Companies Act, even after insertion of explanation, this will be allowable, as and this judgment can come to our rescue because the wordings of explanation is very clear. Only if it is claimed as CSR, it will be disallowed. Legal expenses incurred to protect directors, shareholders in their individual capacity. Legal expenses, if there is a suits between directors and shareholders, and if those legal expenses are incurred by the assessee for protecting by the company, then this expenses should not be allowed. That's a 37(1) business expense. So you cannot protect directors because that does not affect your business. So director's legal case may be because he is doing a business. Another 37(1) important case laws, which I thought I will just trot it out. Advanced license and duty entitlement passment. This is a very good judgment of Supreme Court in Excel Industries. What generally the accrual principles of the law says that if I receive, when I do an export and based on my or export is pending and based on my previous export record, I get an advanced license or I get a credit by way of DEPP. So whether that I should accrue in the books or I should accrue when actually I realize the amount, generally advanced license or DEPP can be utilized against the imports which were made. So the question came before the Supreme Court, wherein the imports were not made, though the advanced license and the credit by way of advanced license was received, and DEPP also is received. The Supreme Court said this is only an hypothetical income which cannot be due tax by applying provisions of 28(4). it can be taxed on this hypothetical level unless and until actually import is made. So if you make an import, then only you will be actually earning this income by way of remission of customs duty. Though most of us, we do it in the books, but this judgment of Supreme Court really helps in, because in various cases, advance licenses are received and EPB are received, but the amounts are not realized till the time imports are being made. And though we are recording, we may record in the books considering provisions of AS 9, but still technically it cannot be taxed based on the Supreme Court. So this may be added back in your income, reduced from your income, sorry, not added back, because it is not taxable based on the Supreme Court. The question arises, what happens if advance license, now it's transferable? A lot of licenses are transferable, like NEI schemes license. If I transfer it after 31st March, now the question arises whether this Supreme Court judgment will come to a rescue, which says this is an hypothetical income on 31st March. Though I have an license in the hand, but it has not been realized, and it cannot be realized, it's only an hypothetical income. The tax would be payable only when actually it is transferred and the amount has been realized. According to me, it can be argued, well, it's an issue, because it depends. Sometimes it may happen that the values in the advance license or amounts may change, or imports may not happen at all. So it remains an hypothetical income in the books of accounts. What should be an AS9, whether that should be recorded is another issue. But though if you're recording in your income, that can be all, it's a very good case that you may not offer for income tax to that extent. Commission and bonus paid to shareholders, directors, whether section 36(1)(2) applies. Now there's a judgment, special bench judgment of Dalal Brocha and stockbroking. In this case, what happened? Commission was paid to both the directors. There were only 2 directors and 2 shareholders, only 50-50%. Now this commission and bonus was paid to this director shareholders without making of dividend payment. So 36(1)(2), which also requires auditor to report in the tax audit, any amounts paid towards commission and bonus, which otherwise was payable as a dividend. So the question was, it applies to all employees, including shareholders. The argument that as no dividend was payable is not acceptable, as word payable does not mean that dividend should be statutory or legally payable. Dalal Brocha stockbroking says that this amount as declared, though paid as commission bonus, is out of portion. There is never a dividend paid. And always what happens is there are only 2 shareholders and directors, and instead of paying a dividend, this has been paid as a commission and bonus. And that time, because dividend would have been paid, there would be a dividend distribution tax, and there was a tax benefit otherwise would available. And therefore it's paid as a commission and bonus to avoid taxation. So 36(1)(2), you need to keep it in mind, this judgment. If you are paying any commission and bonus, it should be substantiated by way of the services which have been provided. There's no evidence to that. Is, if you see the judgment, it says there is no evidence to show that directors have rendered any extra service for payment of huge commission. Assessee has intent to avoid payment of full taxes. Thus, if a reliable conclusion can show that dividend ought to have been paid, and instead of paying dividend, commission was paid, would be attracted. So if you go into this judgment, we need to ensure, advise to the clients, that the commissions and bonus regularly paid to shareholders and directors without declaring any dividend to them can be harmful. If this judgment is applied because it is only paid to shareholders, directors, it can be an issue with it. This provisions has generally been very sparingly been used. You need to look into it. You need to also report it to the tax auditor. So it becomes quite a good big responsibility for the tax assessees as well as the auditor. 36(1)(7) read with 36(2) bad debts in short. 36(1)(7) provides for deduction for bad debts actually written off on irrevocable. So if you want to claim a bad debts, it should be actually written off in the books. What does 36(2) says? A deduction is allowed for debts related to business provision if conditions stipulated under 36(2) are fulfilled. What are that? That should be for business profession. Deduction claimed as bad debt should be actually doing bad in accounting year. That has actually been written off in the books of accounts. Deduction allowed only if corresponding income has been taken into account. So if these conditions are fulfilled under 36(2) and the amount has been actually written as a bad debts in the books, whether then it would be allowed. Now the issue over here arises is, generally what it happens is, assessee makes provision for doubtful debts and they do not write off the bad debts in the books of accounts. But this provision for doubtful debts is reduced from the sundry debtors in the balance sheet presentation. Though in the memorandum books, the ledger remains, and in the books of accounts, the write-off has not been done. A question arises for a consideration is, once this provision for doubtful debts has been reduced from the balance of debtors, does it amount to write-off? in my view, yes, it amounts actually to a write-off. If you see, there is a judgment of Supreme Court in case of Vijaya Bank, which says, well, since assessee has made a provision for bad debts bill by debiting P&L account, said provision was deducted from debtors account or a loans and advance account, and in the balance sheet it is a net of provision, then for the assessee is entitled to benefit under 3617. If you recover later, you offer for tax under 41(4), not a problem. So if you see, the majority of us, if there is a provision made for the debtors or provision for loans and advances, which is otherwise allowable as a business bad debt write-off, nobody is claiming in the computation. This judgment comes to your rescue, which says if those provisions are reduced, so if in your presentation, which is required under the schedules prescribed under Companies Act, that provision has to be reduced from the debtors account or from the loans and account, as the case may be, then obviously it amounts to write-off. And once it amounts to write-off, does not stop you to claim a benefit under section 3617 and 362. So that, though we were not, most of us are not claiming, though it is a provision for doubtful debts, stating that, but technically we can claim the benefit. We can, the Supreme Court judgment in case of Vijaya Bank comes to our rescue, and there are other judgments which says that once the provision has been reduced from the debtors, you should claim the benefit. So tax benefit can be claimed in this regard. 56(2)(7)(b), 56(2)(10) now, Rule 11U, 11UA, as we know, if the value, if any asset which is received below the value of the consideration fair market value, it would be taxable in the hands of the person who is receiving that particular asset, for purpose of which a valuation report is required to be issued by merchant banker. Permitted methods are book value and discounted cash flow. The issue arises is, generally what is happening, we are taking a report, valuation report, and assessing officer do not accept the valuation, especially under the DCF. He says that the projections are totally unrealistic. What he does is, I do a valuation report in assessment year 1890. He assesses after 1 year, 2 years, and after 2 years, he sees the actual results and compares it, that the projections have not been achieved. So once the projections have not achieved, he comes to a conclusion that the valuation report is not correct, and therefore the valuation report is rejected. Question arises for a consideration. Can he does that? There's a judgment of Delhi ITAT, Sinestan, which says that can assessing officer challenge valuation report? It says no, you cannot do. Even if the projections are not achieved, then also you cannot do it. Jaipur ITAT. What if they are unrealistic? What if investment made to comply with bank lending? So investment is made to comply with bank lending, that you should bring in an investments, capital should be brought in, capital should be increased by the promoter. So they subtract the shares and the value which is much higher or much less. And 56 may come in picture. Mumbai ITAT. What a benefit of issue is amongst family. So what happens is, if I'm issuing if the company is issuing at a price, or the shares have been transferred amongst family, Money Estates Private Limited says there shouldn't be a tax impact, because even if I'm getting an assets and investments or the shares for a cheaper value, then the benefit is what I'm getting it is amongst the family, because the shareholders of all the companies, the family members, and ultimately it can be treated as an exempt gift. What are whether exempted entity or transaction that can be brought to tax under section 56(1). We have seen that there are certain exempted entities to whom section 56(2)(7)(b) does not apply, and the assessing officer tries to invoke section 56(1), that is the main section, to tax that at other income. There is a Joel judgment of Supreme Court that if the specific provisions are applicable and exemption has been granted to under 56(2)(7)(b), then it cannot be taxed under 56(1). The exempted entities under 56(2)(7)(b) are venture capital funds and non-residents. So if the non-residents or venture capital funds are investing in any particular company, even at a price which is higher than the fair market value, it cannot be taxed as income because they are exempted. So the assessing officer is trying to tax those under 56(1). So this whole judgment of Supreme Court and High Court can come to your rescue. Whether buyback of shares are covered, Vora Financial Services says no, buyback is not covered. Buyback is not covered because buyback actually is offered to everybody. If somebody exercises rights or not, does not matter. Similarly, rights issue, even if it priced higher than the fair market value and the company is receiving a higher value, it cannot tax, because inter se rights among the shareholder does not change under the rights issue. There is no impact in the hands of investor. This is the proposed determination. So I tried to cover major issues which I thought is relevant in today's time. And now, before 10 minutes, next 10 minutes, I think so we can take questions. I thank you very much, everybody, for the patience hearing. Thank you. Thank you very much.
Thank you, Piyush Bhai. I will take up 3-4 questions at least. One by one, let me ask. First question is, 1 second. One partner dies, firm had a owned office premises with borrowed funds. Due to death, firm is automatically dissolved. What about the premises? Whether it will amount to transfer to the remaining partner? How will be the capital gain tax applicability?
See, as I said, once the partnership gets dissolved, and if any asset is going to any legal head, technically there cannot be any tax. There cannot be any tax on the dissolution. The provisions in one of my slides said that if the amount or capital asset is received by the legal head, because it is taxability arise on receipt of capital asset or money by the partner, then only it is taxable in the hands of the firm. If it is receipt of capital asset to a legal head because of the death of the legal head, and the other asset is going to a firm, then it cannot be taxed in my view, and it should not be taxed.
Now, second question is, if any depreciable asset being industrial premises of proprietor received under will to legatee beneficiary and beneficiary sell the same after 3 years, then whether capital gain arise on the sale of such depreciable asset by beneficiary will be taxable as long-term or deemed short-term capital gain under section 50.
Once the asset is a long-term and you have received it from the, it's a long-term asset. Because you have received under the will, it has been inherited. So the period of the holding would be considered from the date when it was owned by the original assets. So it will remain a long-term asset. The provisions of section 50 will apply for the purpose of calculation. That means you will not get indexation. But for the purpose of 54 EC, that is 50, not 50 EC, 54 EC, you can invest in the bonds. That's a judgment of Bombay High Court, which I mentioned, Acme Builders. And also Manali investment, the tax rate applicable would be 20%. That is under section 112 and not as a 30% or a full tax rate.
One more question from Nitesh Bansal. SSC getting 148 notices on mail, and after login for response, site allowing only to file return. How can we raise question about the reason for which officer want to reopen, as how to raise objection?
Technically, you will have to file a return. And once the return is filed, hereafter you may write a letter to them raising and seeking a copy of reasons recorded. Once a copy of reasons are recorded, that moment of time only you can raise a recording of reasons. What is happening is department is relying upon GK and Drive Shares, a Supreme Court judgment, which says the reasons which actually they are misinterpreting. If I am to read that judgment, it never says that you have to file the return first and then seek reasons. But unfortunately, department is reading like that. कि आप पहले return file करो, उसके बाद हम reasons देंगे. So to be a very practical, you may have to file a return first, then seek reasons recorded. Once you receive a reasons, you are required to take an objection. So that procedure will have to be followed.
Now, last question. Company has incurred an expenditure of 100 as bank charges on transferring capital contribution of ₹1 crore to partnership firm, where he is partner. What amount is to be disallowed under 14A, whether ₹100 or ₹100 plus 1% of 1 crore?
No, company has query on 14A. Company has incurred an expenditure of 100 as bank charges on transferring capital contribution of ₹1 crore to partnership firm where it is a partner. What amount is to be disallowed under 14A, whether ₹100 or only? According to me, till the time you don't earn any exempt income, you should not allow. It's your commercial business. You should claim an expenditure. This will be allowed as an expenditure. It should not be. If you are just contributing a capital, and this capital, obviously, when the company is becoming a partner, there's a commercial expediency attached to it. So it should be claimed if it's a commercial expediency attached to it. But in the year when any profit is received, at that time, if any expenditure is incurred for earning that profit, there will be allowance. In the first year when you're contributing capital, I'm sure if there is no capital profit earned, there will be no disallowance, because it says if the exempt income is not earned, there would be no disallowance. So you may claim initially.
Okay, thank you. Last question from CA Arvind Joshi sir. Premises used for business, depreciation charge, business closed. Now it is given on rent for last few years. Now, if it is now sold, what will be the capital gain tax liability?
According to me, it should be a long-term capital gains again. my view remains a long-term capital gains. There is a dispute in regard to, because you have already cleared the depreciation and thereafter you have shifted from a business asset to an investment asset, offering it for income from house property, whether I should take an indexation on a WDV from that particular date, because it ceases to remain a business asset. According to me, whatever depreciation has been claimed, let it be on the day when it has been transferred from a business asset to an investment asset, when an income from a house property and depreciation is stopped, वो आपकी कॉस्ट गिनी जाएगी और उस कॉस्ट के ऊपर आप इंडेक्सेशन देके लॉन्ग टर्म कैपिटल गेन्स बेनिफिट लेना चाहिए.
Okay, this is the last question, and if there are some questions remaining, I request participant to send us a mail. We can send a mail to Piyush ji to get back all your reply. Thank you, Piyush ji. You have taken time out from your busy schedule and taken such an interesting session for Thane branch. Now I request CA Naveen Dedia to propose formal vote of thanks. Naveen ji, please. नवीन भाई, नवीन भाई अनम्यूट करो.
अनम्यूट तो किया हो. हाँ, अभी हुआ.
हाँ.
सर, अभी सब चाबियां आपके पास, हमारे पास एक भी चाबी नहीं. चलो, अच्छी बात है. बहुत बढ़िया सर. और कॉन्ग्रेचुलेशन टू थाने ब्रांच फॉर अरेंजिंग a topic which is very useful, day-to-day usefulness of the subjects. The Asawaji and his team, congratulations. And I propose hearty vote of thanks to Piyush ji. Piyush ji ने छोटा प्रॉब्लम को बड़ा बताया, बड़ा को छोटा किया, छोटे को फिर सॉल्यूशन किया, फिर छोड़ दिया जजमेंट के ऊपर, जजमेंट से सॉल्यूशन निकाला. सच्ची I am appreciating the way he presented. It is very helpful to day practice problems, and I thank again to Piyush ji. Keep it up and educate us so that we can practice well.
Thank you.
Thank you, sir.
Thank you very much. Thank you.
Yes.
Thank you, sir.
Now I thank you all the participants, and please do join us tomorrow and day after tomorrow for third day and fourth day of this series. There are interesting sessions to be taken by Sanjay Khimani sir and Onkar Gadgil. Please do join us. Thank you for patient hearing. Thank you, Piyush ji, once again. And by this, now I close end of this session.
Thank you.